Hello friends, this is Jigar Mistry from Buoyant Capital. We run the Buoyant Opportunities Fund. I'm sure by now you have heard a lot about the coronavirus and its associated health and economic impact. In this message, I intend to limit the discussions on how best we are positioned to deal with it. I shall break down the discussion in three parts. One, markets, the do's and don'ts. Two, how India is positioned to deal with it. And lastly, how are we going about building a portfolio. Firstly, as you know, there isn't a precedent in the living memory on how to deal with this. The challenge is big and we don't really know how to navigate it. The Spanish flu in 1918 came closest, but it isn't in the living memory. And two, the world was a much rounder place, as in the global trade wasn't very high. So the impact that it would have had on the economies will be very different from the ones we are going to see now. So the first section, the do's and don'ts on the markets. Do's first. There is an old saying that whatever doesn't kill you makes you stronger. The virus might stay with us for much longer and the economic crises will tide over sooner. Coming out of the crisis, the idea is to identify businesses and companies that become stronger from a balance sheet perspective, from a relative competitive standpoint, etc. Secondly, although the precedent isn't available on a global scale, different countries are peaking in the crisis at different points. The consumer behavior during the partial or the total lockdown, and once the lockdown is lifted, is presenting very valuable insights into how India's recovery will happen. And thirdly, the lockdown, as long as the one that we are going to see, could be habit altering. Would it lead to more people working from home and its impact on commercial real estate? Will it lead to lower consumption in alcohol and cigarettes? Would it lead to down trading? Complete opposite to the premiumization trends we have seen over the last decade or so. On to the don'ts then. Firstly, don't confuse the market price as the true value of the businesses you own. In crisis, marginal sellers set the prices and majority's opinion doesn't have a very large say in the shorter term. Don't get disheartened by the mark-to-market value of your portfolio. Think only in terms of taking the right incremental decisions. Secondly, don't focus on the noise. Instead, focus on fundamentals. Stocks that have held up very well in the crises might not be the best investments as we come out of it. Lastly, try and not time investments based on market feedback. That is, start investing when the market is up, start selling when the market is down. Invest your time rather at identifying the businesses that will survive this crisis and work out the best price you're willing to pay for such businesses and then wait. As Buffett said, activity can be the enemy of investing. Now coming on to the second part, how is India positioned? Although the coronavirus has gathered a lot of mind share, to us the steep fall in crude price was the bigger story. We think that the crude price will stay lower for longer, whereas the negative impact of coronavirus is more on the near term. The positive impact of lower crude prices, even adjusting for the lower remittances, will both be more meaningful to the current account, that is the BOP, current account, BOP, government finances and inflation, as well as more enduring. Secondly, as the fallout of the virus, the global trade will likely shift and companies might start thinking of life cycle costing rather than the unitary costing which is lowest today. This will likely move supply chains away from China and India might actually have a serious shot in some areas. Thirdly, in the above aspect, the India's strength, which is abundant English-speaking engineering background pool, is unlikely to be replaced by countries offering to do so at a lower cost. India might be able to gnaw at their markets while protecting its own turf. Lastly, India has traditionally been a savings economy. Yes, the saving rates have come down over the last decade or so, but at the household levels, India is not seriously leveraged as much as some of the Western countries. Indian consumption story will likely normalize faster once these things settle. On to the last part then, how are we going about creating a portfolio? I'll focus more on the sectors in this section. The broad idea is still to own businesses with a strong balance sheet in the portfolio, As I had said earlier, the businesses that will come out of the crisis successful will likely have lower fixed costs, stronger balance sheets, and will be accompanied by weaker competition. The first instinct is to buy those anti-fragile companies, the ones that benefit from the virus. Within this bucket, the businesses that manufacture pharmaceutical API are worth a little lesser to us compared to, say, a man guarding company. The latter's business is simply more longer term. Within consumption itself, there are some areas that will take longer to revive. For example, travel and hospitality, aviation, multiplexes, or discretionary spend. But some might revive much sooner, for example, retail, QSR, etc. Also, governments around the world might try and boost investment spending, which will mean related sectors like cement might do well. Thirdly, with central bank infusing liquidity, some global commodities like metals would get interesting at some point in time. A lot of the businesses are down 25 to 50%, which are bad, but a lot of good businesses are equally down as well. Use this time to correct your mistakes. If you know that the business you are invested in was historically and theoretically bad, don't wait for it to come back to your original buying price. Book losses now and invest in a better business which has not fallen as much but might recover much faster. Lastly, it is pertinent to remember that each crisis alters the economic fabric of the nation and the globe. Many companies simply won't make a comeback. Investing in them, whatever the valuations, continues to remain a mistake. Let me try and end this by saying that times are challenging and waters we are in are rather uncharted. Like the fundamentals, the investing wisdom which has been passed on from generation doesn't change very often. Just like we are watchful of building resilience against the virus, we owe an equal opportunity and an equal duty to help in keeping the emotions in check and building an equally resilient investment approach. That's it from my end. Thank you for listening to me, and we look forward to connecting sometime soon. Cheers.